Good morning and welcome to TOITOI Japan Market Radio for Friday, January 17, 2026. I'm your host coming to you from Tokyo with today's briefing on Japanese equities, currency, and rates for global investors tracking Japan exposure. Markets here were actually closed today for a national holiday, but there's plenty to unpack in the headlines and positioning ahead of next week's trade. Joining me as always is our portfolio manager focused on Japan macro. Let's start with the market overview.
Thanks for having me. So yes, the Tokyo Stock Exchange was dark today due to the holiday, which means no price action in the Nikkei 225 or TOPIX, and no domestic JGB trading either. That said, we did see some overnight moves in dollar-yen and US equity futures that are setting the tone for when Tokyo reopens Monday. The key theme heading into next week is really a combination of domestic political jitters and external risks from Fed uncertainty and geopolitical tensions. We'll want to watch how those factors interact with positioning after the long weekend.
Perfect setup. Let's dive into the first headline, which actually came out earlier today despite the market closure. The Nikkei index had declined in the previous session on January 17 due to political concerns, according to reporting from the Tokyo Stock Exchange wrap. The sell-off was driven primarily by domestic political developments rather than corporate earnings or macro data. Can you walk us through why political risk is moving Japanese equities right now?
Absolutely. Political uncertainty in Japan tends to create near-term volatility because investors start questioning policy continuity, especially around fiscal stimulus, corporate tax policy, and coordination with the Bank of Japan. When you have political developments that threaten the stability of the government or the ruling coalition, market participants pull back because they can't price future policy with confidence. In this case, the snippet doesn't give us the full details of what specific political issue triggered the decline, but the pattern is familiar. Japanese equities are quite sensitive to the political landscape because policymakers have such direct influence on economic stimulus packages and structural reform agendas.
And how does that political risk typically translate into the yen and JGB yields?
Good question. Political uncertainty often triggers a risk-off move, which paradoxically tends to support the yen as a safe haven asset. So even though the equity market is under pressure, you might see dollar-yen decline, meaning yen appreciation, especially if global sentiment is already fragile. On the JGB side, flight to quality demand would push yields lower as investors rotate into Japanese government bonds. The magnitude really depends on how severe the political issue is and whether it looks likely to resolve quickly or drag on. But the initial reflex is usually yen strength and lower yields alongside weaker equities.
That makes sense. So the immediate playbook is downward pressure on Nikkei and TOPIX, potential yen appreciation, and modestly lower JGB yields until we get clarity. Now shifting to the external picture, we had a Wall Street sell-off overnight driven by uncertainty around Federal Reserve leadership and escalating geopolitical tensions. U.S. equities declined as investors grappled with policy ambiguity at the Fed and heightened international risks. How does that spill over into Japanese markets when Tokyo reopens?
This is a critical dynamic for Japan. First, on the monetary policy side, Fed uncertainty may delay U.S. rate normalization, which keeps carried trade dynamics potentially favorable for yen-funded positions in the near term, though it also injects volatility. Second, geopolitical tensions and Wall Street weakness typically trigger safe haven demand, which again supports the yen and pressures Japanese export-exposed equities. Third, we often see capital flows rebalance out of Japanese equities when global risk assets face sustained selling pressure. So the combination of Wall Street down and geopolitical risk up is a headwind for Nikkei and TOPIX.
And presumably that safe haven flow into yen creates a double whammy for Japanese exporters, right? Both weaker global demand sentiment and a stronger currency.
Exactly. Japanese exporters are particularly vulnerable in this environment because they face both the direct hit from reduced global risk appetite and the margin compression from yen appreciation. On the rate side, we'd expect downward pressure on JGB yields as well, driven by flight to quality and the potential for U.S. Treasury yields to decline if the Fed pause narrative gains traction. The key monitoring points here are Fed communications for any clarity on leadership and policy direction, and whether geopolitical tensions escalate or de-escalate in the coming days. Those will be the directional cues for Japanese assets.
So a fairly clear risk-off setup across the board. Now let's turn to a sector-specific story that has implications for Japan's semiconductor supply chain. South Korea's government came out today saying that proposed U.S. chip tariffs will have limited immediate impact on Korean semiconductor manufacturers. Japan is deeply embedded in the global chip supply chain, both as a consumer of chips in autos and electronics and as a supplier of chip-making equipment and materials. How should we think about this development for Japanese markets?
This is nuanced. If Korean chip producers absorb U.S. tariffs better than expected, they may gain market share against Japanese competitors, which would be a headwind for Japanese chipmakers like Sony and Renesas. On the flip side, if tariffs create any supply disruptions, Japanese equipment makers such as Tokyo Electron, Advantest, and Shin Etsu Chemical could see increased orders for replacement sourcing or alternative capacity. The longer-term risk is that the tariff regime accelerates regional diversification away from both Korea and Japan, which would pressure margins across the board. So it's a mixed picture for Japanese equities in the semiconductor and equipment space.
And does this introduce any broader risk-off dynamics for yen or JGBs?
Potentially, yes. If tariffs escalate beyond chips or if retaliation spreads, you'd see risk-off sentiment support the yen as a safe haven. JGB yields would likely decline as investors rotate into Japanese government bonds for safety. The Bank of Japan's yield curve control policy could face some technical pressure if long-end yields move sharply, but in the near term, the flight to quality bid would dominate. The key watch is the full scope of U.S. tariff details, any exemptions for Japan, and whether the BOJ signals any policy response to FX or yield volatility. If dollar-yen moves sharply on tariff fears, the BOJ might feel compelled to address it verbally or through intervention.
So across these three stories, domestic political jitters, Wall Street sell-off and Fed uncertainty, and chip tariff headlines, we're seeing a consistent theme of risk-off pressure on Japanese equities, yen strength, and lower yields. When Tokyo reopens Monday, what's the main risk scenario investors should be positioned for?
The main risk scenario is a gap-down open in Nikkei and TOPIX driven by the combination of political uncertainty domestically and negative external sentiment from Wall Street and geopolitical tensions. Yen appreciation could accelerate if safe haven flows intensify, putting additional pressure on exporters. On the upside, if we get clarity on the political issue over the weekend or if Fed officials provide calming guidance, you could see some of that risk premium come out in a modest relief rally. But the base case is defensive positioning, with investors favoring domestic-oriented stocks, utilities, and staples over cyclicals and exporters. JGB yields should stay well anchored given BOJ policy and flight to quality dynamics.
That's a clear framework. Before we wrap, any final thoughts for global investors tracking Japan exposure heading into next week?
I'd say keep an eye on three things. First, any news flow on the domestic political situation and whether it stabilizes or escalates. Second, Fed communications and U.S. Treasury yields, which will drive global risk sentiment and dollar-yen direction. Third, watch for BOJ commentary, especially if yen moves sharply or if JGB market functioning shows any stress. The interplay between domestic politics and external risk is the key driver right now, and both can shift quickly. Stay nimble and avoid over-concentration in export-heavy names until we get more clarity.
Excellent summary. That's all for today's briefing on TOITOI Japan Market Radio. If you're a global investor tracking Japanese equities, currency, or rates, consider subscribing for our daily updates. We'll be back Monday with live market reaction when Tokyo reopens. Thanks for listening.